Okay, Cami, what do we need to know? The OECD has released its quarterly report, the first since Donald Trump imposed tariffs.
The Federal Reserve slashes its US economic growth outlook to a concerning 1.6% by 2026, a significant downward revision directly tied to the uncertainty created by Trump's aggressive tariff policies. Fed Chair Jerome Powell's revealing admission, "We just don't know really very much at all about the actual policy," represents an extraordinary acknowledgement of uncertainty from America's central bank. This institutional confusion raises critical questions about economic stability. As markets react to this significant shift in forecasting, how should you adjust your financial strategies in response to this unprecedented economic ambiguity? The numbers on the Federal Reserve's economic projections dashboard have shifted dramatically, marking a turning point in the central bank's outlook for America's economic future. After maintaining relatively optimistic forecasts throughout early 2023, the Fed has now delivered a sobering reassessment that carries significant implications for markets, businesses, and consumers alike. The central bank has significantly downgraded its outlook, moving from projecting steady economic expansion to forecasting a substantial deceleration. What was once viewed as a resilient economic vessel now appears to be entering choppy waters. GDP growth is now expected to reach just 2.2% in 2025, before slowing further to 1.6% by 2026, figures that signal an economy struggling to maintain momentum in the coming years. This revision represents an unusually substantial shift in the Fed's typically incremental forecasting approach. While previous adjustments often reflected modest data evolution, this comprehensive reassessment constitutes the Federal Reserve's first formal evaluation of how proposed tariff policies could impact economic performance. Their economic models have identified substantial headwinds that weren't fully accounted for in previous projections. Financial markets reacted immediately and severely to these revised figures. The Dow Jones Industrial Average plunged over 1,100 points, approximately 2.6%, as investors rapidly reassessed investment theses built on expectations of stronger performance. This market response demonstrates how the Fed's new projections caught many by surprise, forcing a dramatic recalibration of market sentiment. The Federal Reserve's concerns find validation in parallel revisions from the Organization for Economic Cooperation and Development, OECD, which has similarly downgraded both US and global economic outlooks. This alignment between independent forecasters suggests these growth concerns represent substantive economic analysis rather than isolated perspectives. During his press conference, Federal Reserve Chair Jerome Powell characterized the decision to revise projections as a closer call, while defending it as the best decision to fulfill the Fed's mandated objectives of maximum employment and price stability. Powell highlighted unprecedented challenges in economic forecasting due to trade policy uncertainty, noting, "We just don't know really very much at all about the actual policy. We don't know what will be tariffed, from what countries, for how long, in what size." These revisions extend beyond abstract statistics to real-world implications. For businesses, slower growth could impact investment decisions, hiring plans, and revenue projections. Workers may face fewer job opportunities and potentially weaker wage growth. Investors confront the prospect of more challenging returns as corporate profits encounter headwinds from a decelerating economy. All consequences of what appears to be a fundamental shift in America's economic trajectory. Behind the Federal Reserve's cautious projections lies a profound economic wildcard that's reshaping America's growth trajectory. While economists routinely navigate uncertainties, the scale and variability of Trump's proposed tariff policies represent something fundamentally different. A policy environment where even America's top economic analysts admit the future direction remains uncharted territory. Trump's tariff proposals target America's three largest trading partners simultaneously, creating an unprecedented scenario in modern economic planning. The proposed measures include tariffs of up to 25% on imports from China, Mexico, and Canada, nations deeply integrated into US supply chains across virtually every sector of the economy. These tariffs function much like unexpected tolls suddenly placed on established delivery routes, immediately disrupting the flow of goods, increasing costs, and forcing businesses to recalculate their operations. What makes these tariff proposals particularly challenging for economic forecasters is their fluid implementation. The temporary pause on tariffs against Mexico following diplomatic negotiations demonstrates how quickly the trade landscape can shift. This pause came after Mexico agreed to deploy troops to its border to combat drug trafficking, an agreement that could be rescinded or modified at any point, potentially reinstating the tariff threat. This policy volatility undermines the stable conditions needed for economic forecasting, similar to how the oil embargoes of the 1970s created persistent planning challenges that extended beyond their immediate impact. The Federal Reserve faces an additional layer of complexity through potential retaliatory measures from affected nations. Historical patterns suggest that trade partners rarely absorb tariffs without response. Countries like China and Canada may implement their own counter-tariffs on American exports, creating secondary economic effects that further complicate projections. These retaliatory measures could target strategic U.S. industries, amplifying economic disruption beyond direct tariff implementation. Inflation presents another significant concern in the Federal Reserve's calculus. Economic analysts estimate that the proposed tariffs could increase U.S. inflation by 0.5 to 1 percentage points through 2026. More specifically, tariffs on Canada, China, and Mexico are projected to push core PCE inflation, the Federal Reserve's preferred inflation metric, to approximately 2.8% in the fourth quarter of 2025. This inflationary pressure creates a particularly challenging scenario as the Federal Reserve attempts to balance its dual mandate of price stability and maximum employment. The exceptional challenge these tariff proposals create becomes evident when examining how they force the Federal Reserve to prepare for multiple potential economic scenarios simultaneously. Unlike typical policy changes that allow for measured responses, the current tariff proposals could materialize in numerous forms, with vastly different economic impacts, extending beyond immediate effects to include longer-term structural changes to supply chains that could permanently alter economic patterns. When a tariff hits the global trading system, it's not merely a policy announcement from Washington, it's the beginning of a complex economic ripple effect with mathematical precision. The mechanism through which tariffs transform from political decisions into tangible GDP losses follows predictable patterns that economists can quantify even as they struggle with the unprecedented scale of current proposals. These economic consequences stem from structural disruptions that systematically constrain growth potential across multiple channels simultaneously. Tariffs operate as taxes imposed at the border, creating immediate price distortions that propagate throughout supply chains like a chain reaction of falling dominoes. When a component faces a 25% tariff upon entering the United States, this cost increase initiates a cascade of adjustments as manufacturers recalculate production strategies and pricing decisions. In the automotive sector, where a single vehicle might have components crossing borders multiple times during assembly, each crossing becomes subject to taxation, forcing costly reorganizations of established production systems that developed over decades following NAFTA's implementation. Economic assessments of tariffs reveal competing perspectives. Proponents maintain that tariffs protect domestic industries facing unfair foreign competition, preserving manufacturing jobs and industrial capacity for national security concerns. This view emphasizes benefits to specific sectors and communities that might otherwise face devastating competition from lower-cost producers abroad. Critics point to market distortions that reduce economic efficiency, creating deadweight losses exceeding targeted benefits. When resources shift to less efficient domestic production solely because of artificial price signals, the economy produces fewer goods with the same inputs, the textbook definition of reduced productivity and slower growth. The capital investment implications create significant economic drag. Businesses facing rising input costs and component uncertainty respond by delaying or canceling planned investments. This capital formation slowdown directly reduces productive capacity growth as fewer factories, equipment upgrades, and technology investments materialize. Since capital deepening drives long-term productivity improvements, this investment pullback damages economic potential beyond the immediate tariff period. Consumer impacts amplify these effects as companies pass increased production costs to consumers through higher prices. With consumer spending driving approximately 70% of U.S. economic activity, Even modest price increases across goods significantly dampen overall demand. Households facing higher costs must either reduce consumption, deplete savings, or increase debt, none supporting sustainable growth. JP Morgan economists project that proposed tariffs could reduce US GDP by between 0.5 and 1 percentage point through 2026, integrating multiple economic channels. With growth hovering around 2%, this reduction represents a substantial portion of expected expansion and risks, triggering negative feedback loops as business confidence erodes, hiring slows, and consumer sentiment weakens. This self-reinforcing cycle of economic constraint now places the Federal Reserve in what could be the most consequential monetary policy predicament of the decade. The central bank has just cut interest rates by a quarter percentage point, bringing the benchmark rate to between 4.25% and 4.50%. This adjustment reflects their response to cooling inflation and concerning labor market signals, with October's dismal addition of only 12,000 jobs highlighting the economic fragility that now demands their attention. The Federal Reserve confronts a textbook policy dilemma between two competing priorities. Should it combat inflation by maintaining higher interest rates or accelerate rate cuts to stimulate a slowing economy? Tariff policies have created a stagflationary environment where growth slows while prices continue rising. Unlike typical economic cycles where objectives align, these inflationary pressures pull monetary policy in opposing directions. The central bank had initially planned multiple interest rate reductions throughout 2025 to support economic growth as inflation naturally subsided, but tariffs have fundamentally altered this trajectory. Chair Jerome Powell acknowledged this uncertainty during the Fed's recent press conference with unusual candor. "When the path is uncertain, you go a little bit slower." This statement signals a meaningful shift toward caution, departing from the Fed's previous confidence in its rate-cutting timeline. The central bank recognizes that premature reductions could fuel inflation already pressured upward by tariffs. The Fed's cautious stance appears clearly in their December projections. The median federal funds rate for 2025 now sits at 3.9%, higher than the previous 3.6% forecast. This adjustment represents a substantial policy shift, indicating fewer planned rate cuts than markets anticipated. The implication is clear. The Federal Reserve is preparing to provide less monetary accommodation precisely when economic growth may require additional support. Independent analysis from Evercore IS reinforces these concerns. Their models suggest core PCE inflation, the Fed's preferred inflation measure, could reach approximately 2.8% in the fourth quarter of 2025. This elevation would likely eliminate at least one and possibly both remaining Fed cuts previously planned for that year. The central bank, bound by its price stability mandate, would be unable to deliver monetary support that a slowing economy might otherwise warrant. This monetary policy trap represents the most direct collision between the Federal Reserve's dual mandate, price stability and maximum employment, in recent memory. Financial markets have already begun adjusting to this reality. Bond yields have increased as investors recalibrate their expectations. This creates its own feedback mechanism: higher borrowing costs that further constrain economic activity independent of official policy decisions. Historical precedent offers little comfort. Supply-side price shocks have consistently challenged monetary authorities, often leading to policy mistakes. The Federal Reserve now attempts to thread this needle under unprecedented scrutiny. As the Federal Reserve recalibrates its approach amidst tariff pressures, the notion of a single unified American economy becomes increasingly obsolete. Manufacturing has languished in contraction territory for nearly 2 years, according to the Institute for Supply Management, while domestic steel producers anticipate potential windfall profits. Two economic realities occurring simultaneously within the same national borders. This sectoral divergence represents perhaps the most consequential yet least discussed aspect of our current economic trajectory. October's anemic job growth of just 12,000 positions marked the slowest expansion in nearly 4 years, indicating broad economic vulnerability before any significant tariffs were implemented. The labor market appears poised for further deterioration as growth projections decline, with trade-exposed industries likely implementing hiring freezes or workforce reductions to preserve margins. This economic bifurcation extends beyond industry sectors to geographic regions. States heavily dependent on international trade, such as Michigan, Texas, and Washington, face disproportionate exposure to downside risks compared to states with more domestically oriented economic bases, potentially widening existing economic inequalities. Manufacturing's persistent weakness serves as a harbinger of broader vulnerabilities. American factories have struggled with declining production capacity utilization throughout 2023 and into 2024. Consider a Michigan auto parts supplier who has watched orders steadily decrease while being told to prepare for potential border complications that would further disrupt operations. The automotive sector exemplifies this vulnerability with particular clarity. Modern vehicles cross North American borders multiple times during assembly, with components sourced throughout the USMCA region. This integration, developed over 3 decades of tariff-free trade, cannot be restructured without significant efficiency losses. Major automakers have already begun revising investment plans that would inevitably result in higher consumer prices. Housing operates at its lowest activity level in nearly 3 decades, according to Fannie Mae data. Local builders already facing elevated financing costs now confront increased expenses for essential inputs like Canadian lumber. A Denver contractor who planned 15 new homes this year has already reduced his projection to 8 due to cost uncertainties. Electronics and consumer goods sectors operate on narrow margins with complex global supply chains. Tariffs would necessitate either margin compression or consumer price increases. Neither option supports sustained business growth for retailers and manufacturers, who cannot easily reconfigure their supply networks. Against these sectoral challenges, certain domestic industries stand positioned as potential beneficiaries. American steel and aluminum producers would likely see reduced foreign competition and improved pricing power. The economic transformation creates distinct winners and losers rather than uniform national impact, representing a fundamental reshaping of America's economic landscape. As we conclude our analysis, it's important to recognize how central bankers adapt during uncertain times. Jerome Powell's metaphor about navigating through fog or a furniture-filled dark room perfectly captures the Federal Reserve's cautious stance amid trade policy ambiguities, like a ship's captain reducing speed when visibility drops, adjusting course as new obstacles emerge. The 2019 trade war showed how economies can adapt to uncertainties over time. The Fed implemented rate cuts despite inflation concerns, treating these as transitory disruptions rather than permanent features. What might this mean for your business or portfolio? The coming quarters will reveal whether the Fed's cautious recalibration was warranted. Like Powell, we must all move deliberately while remaining alert to both emerging risks and unexpected opportunities in this economic fog.